Welcome to part 4 of Option Greeks. In this video, we'll be looking at Vega. Now, to be perfectly honest, knowing the exact value of Vega, it's not quite as critical to option trading as some of the other Greeks we've already covered in previous videos. Things like delta, gamma, and theta. Now, that being said though, it's still an important metric. And any knowledge that you can gain to improve your overall trading, well, it's going to just help you in the long run. So stick around after the intro, and we'll go over everything that you need to know about Vega. Alright, so just like in the previous videos, let's start off first with what is Vega? Well, from a purely mathematical perspective, it's the first derivative of an option price with respect to implied volatility. In other words, it gives you the expected change of an option price for every 1% increase in implied volatility. And just so there's no confusion on this, let's add one more definition up there. Implied volatility is a measure of the market's expectation of future price fluctuations of a stock. In other words, how much is the price expected to move over a given period of time? And just as a quick side note, if you want to know how to calculate the expected move in a stock based on its implied volatility, check out the link in the upper right hand corner. I did a video on that here just recently. Okay, so back to Vega. Now, based on these definitions, we can pretty easily see that if you're long options, and it doesn't matter if it's calls or puts, for any long option position, you're going to profit from an increase in implied volatility. So that means your Vega is going to be positive. On the flip side, when you sell options, again, doesn't matter if it's calls or puts, when you're short options, you're going to benefit from a decreasing implied volatility. So in this case, Vega is always going to be negative. Now, just like the other Greeks, Vega is not constant. There are a few things that'll cause Vega to increase or decrease. Now, this graph shows two of the most important things that will affect Vega: the moneyness of an option and the time to expiry. So you can see from the chart that Vega is highest for options that are right at the money, and it drops off fairly quickly as you get further in or out of the money. Vega is also higher for longer dated options. This is a reflection of Vega's sensitivity to time. The more time that an option has until expiry, the more sensitive Vega is to any changes in implied volatility. Okay, so that's the theory behind Vega. Now, how do we put this knowledge to use? Well, first, let me point out that whenever you trade options, there are three basic ways that you can make money. And those are when you have increases or decreases in delta, theta, or Vega. And the increase or decrease depends on if you're long or short the option. Now, the great news about Vega is this. If you're already monitoring delta and theta, and that's both on an individual trade perspective and on your overall portfolio, and we covered both of those methods in those previous videos. So if you're already monitoring delta and theta, you don't really need to do any additional monitoring for Vega. Delta and theta will take care of Vega. So you're probably asking yourself now, well, then what's the point of even knowing what Vega is? Well, I'm glad you asked. The most important thing to know about Vega is not the actual number, but if you are positive or negative Vega. And that's both on an individual trade and your overall portfolio. And here's why. As a general rule, the implied volatility of the market decreases more often than it increases. And that's why I'm primarily a seller of options. When you sell options, both theta and Vega are making you money simply with the passage of time, even if the stock trades sideways. And delta, well, delta helped you choose the strike prices when you were getting in the trade to give you the correct probability of that option expiring out of the money. But you need to be aware that at times market volatility does increase. And when it increases, it usually does so very quickly. You need to understand that side of implied volatility in order to effectively manage your risk whenever you're selling options. So that brings us to the two most important things that you need to remember about Vega. The first is, if you're expecting the implied volatility to decrease over the time of your option trade, you want to sell options so that you're negative Vega. However, if you're expecting the implied volatility to increase over the time of your trade, you want to buy options because you want to be positive Vega. And it's really that simple. If you keep these two bullet points in mind when making any option trade, you're using Vega to your advantage. It's really all you need to know about Vega. And again, if you take a look at the top right hand side of the screen, I'll post a link to a video there I did on options trading, where I go over several scenarios to help you try and decide if you think the implied volatility is going to increase or decrease over the time frame that you're looking at. Alright, well, I hope this video helped you to understand what Vega is and how to use it. Please share this video with your trading friends, and if you're enjoying the content, hit those like and subscribe buttons, and we'll see you next time.